Okay, so this is going to be a brief conversation, hopefully. What do I want to for? Where is it? LFV. So I'm going to talk about let's need a clean chart first. Explain the concept, the theory of order pairing, right? And it's basically looking at highs and lows in the market and how candles close there. The theory is built on the idea that
yes,
I would have blouse and skirt. I will scream yes.
I was gonna mute everyone just to be on the safe side. Somebody probably caught a good trade.
Scream yes like that mean you're gone.
Okay. All right. So the idea is going to be built on, like I said, how we close at highs and lows. So just using this random chart. Let's see if I have that thingy on. I do. Cool. So let's take a look at these highs and lows, starting from the ones on the left. That low. Now, as the market's trading away from this low right here, we can see that all of this is now sell-side liquidity, building below these lows, all that good stuff, right? Not been taken, and we want to pay attention to the candle that closes through that low. So the first candle that closes through the low is this one right there. Let's fill in the box and make it pretty. Nasdaq as it should. 10,700 coming up. All right, so that candle right there is going to be the candle that closes through here. If we're of the belief that from our institutional logic, all right, all that good stuff that we learned from ICT, if we believe that sell stops resting at the lows and buy stops resting at the highs are paired with liquidity, meaning market makers are buying the sell stops here and selling to willing buy stops up here. If we believe that when price comes here, essentially we're looking for a stop point at the lows or a stop point at the highs, right? So we're not looking for the market to be closing through the lows at any point in time with that logic. So I want to keep that idea in mind because it's going to be very important in understanding this idea. It's just a theory. I've seen great results with it, and I think I'd like to share it now. So let's take a look at the low. The fact that this candle body is closing through the lows and we don't have like a stop point there, this is telling me that the market makers are not buying into this. They're selling here. In an ideal world, I want it to look like this. Let me grab a little bit of, so let's say this is a low, high, coming down to the low. Under bearish scenarios, I want to see, I'm going to draw 3 bearish candles here. Right. So in a perfect scenario, I want to see it form like that. So that and that. So this low here is the one that we're closing through. And the candle that closes through the low, I want that candle to be the middle candle of a fair value gap, 3 candle pattern. When that happens, I focus on this area right in here as being fair value for more selling. Now, what does that mean? It means that the stops that were resting down here, they were not bought right here. Market maker was selling. This is volume. Bodies represent volume, right? So as we're driving into this liquidity pool and the market makers are also selling and not buying into this, it means that they're targeting a liquidity pool that is maybe lower. I don't know, lower. Let's call it that lower, right? If this push right here fails to take this, then the stops that we will be pulling right here are going to be my target. And I want this delivery. I want the market to trade back up into here fill in all of the inefficiency here, because since we're trading into a pool of sell stops, there was no buying. We have ISB's buy side imbalance, sell side inefficiency here. I want to see the market trade back here and offer buy side. Then I want to see that. This is when a fair value gap, in my opinion, is highly probable or highly probable. Yes, that word. It's very likely that this fair value gap will produce a swing that will take out a previous low, especially if this did not take the liquidity. So remember, this would have been the first pool of liquidity. They didn't buy here, so I'm not looking for a push higher. We closed through here. If this moves away fast and it's a very big candle, like let's say that's low right there, and then we have a big candle like that. These are even better, because once this candle closes, I know frame that price to that price as an inefficiently traded portion of price, where we had sell stops here that were not bought. We sold into that liquidity pool. So we have an excessive selling taking place here. And I believe that that is what causes these candles. So once you're looking at the lows, any lows for that matter, and we're seeing them expand through the low like that with big bodies, that's telling us that they're selling there. So I'm waiting for them to come back, add more orders here, and then go low. All right? So let's take a look at some examples with this. And I might probably introduce a new idea. So let's take a look at, perfect, here's an example. Here's a low. We expand through the low. So this candle's closing price right there. And that line is going to be an imbalance I'll be looking for. So I'd want to see price trade back up into that imbalance to fill it. So what I mean? Now this candle right here is also the middle candle of 3-bar pattern, or the FVG. So price trading back inside here, right there, is perfectly fine for a stop hunt to go low. But that portion right there, that low to the closing price of that candle, would be where my main focus is. So if we where's the fractal? I think the fractal is right here. So on a lower time frame, it's happening very fast, because that was a 5-minute chart. We can see one candle push, and then the very next candle just goes back up, immediately rebalances, and then it dies off. This portion now is going to be that inefficiently traded portion of price that we can see the market come back to. The imbalance has already been filled. Since we're watching this live, probably come back to this later. But let's look at another example of the idea. Let's look at the lows. Look at the market expanding through the lows. This candle, that's the expansion through the low. So the imbalance is going to be closing price of that candle right there to that point. Market trades up, offers buy side inside here, moves away. Again, same rebalance idea, then it starts to die. You can flip this idea and look at it from a bullish perspective as well. This right here is something else, right? This is when you expect a high in the market to stay. So we have the high right here, gap through, because we know that this should be the imbalance that they should rebalance and then trade higher. The fact that they're coming back inside here to offer this much is telling us that this 3-bar FVG right there should form a high in the market. Whether it's going to be a long-term high, short-term high, we don't know, but that high should stay for now. So if we look at this entire fractal, and we can see the market trading higher, 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 no runs on sell-side liquidity. All of that sell-side liquidity building up. Higher, 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 then it starts failing to be supported by this pattern. So we're breaking highs, closing above them, but we're not staying above that imbalance. So that imbalance right there that goes through the high, we come back below it. Once we come back below it right there, here's the fun part. Take this off, like that. This candle right here becomes the high of the imbalance, and this is the candle that closes through it. So the imbalance that we're looking for, just like this for an entry, is going to be right inside here. So again, while there are times when based on market structure, we can see the market just wick higher, this right here is the portion of price that we want to see them deliver bodies and then move away. So this is the theory of order pairing, or my theory of order pairing. Let's go on a different time frame. Oh, see, same thing here, or same thing happening now. Failed, trades up, look at that body, wicks inside, and then it moves away. Depending on the time frame that you find this on, you could be really ninja mode and trade or fade this move inside. It's risky. It's risky if you don't have enough confluence, but once you can identify a point inside this area that it's likely to support bearish price action, well, why guess when you can just look? Go back to a 1 minute chart. Let's take a look at inside here, right? This right here is enough to stop this. I don't know if it's gonna stop it forever, but this is enough. This is an idea I got from old ICT YouTube video about a balanced price range. If we have that and that being a range of price, when the market does this, it's balanced. That range of price is not balanced. This is 3 passes through a range. That right there is what I look for. For a range of price where the market passes through it 3 times. That's the magic number. I guess power of 3. So this candle right here is passing through that range there 3 times. And I'll kind of explain why I'm saying that. So to form the body, sell side delivery, to form the wicks of a down candle, it's gonna be going up, coming down. So 3 passes through that range. That's what we have right here. So these are areas that you can scalp on a lower time frame, ninja mode, especially if they're forming in areas where we have confluence, right? The more the confluence, the better. We all know that. Let's clear up this and move to a different chart, maybe. Different time frame, maybe. I don't know how. Yuck. Let's do. Someone's in the chat. This is not the sauce. It is an observation, right? So let's take a look at this price action right here. The lows from there cannot expand to the low between the closing price of that candle. That's an imbalance. Price traded up into a portion of the imbalance, stopping at that high. Then we died. So this is an open imbalance in the market, commonly defined by ICT as sell-side imbalance, buy-side inefficiency, right? Same idea here. We have lows right there, gap through it. Now this is a gap, so that's different. We can see that this, we already know that that's inefficiently traded. So don't have to go into that portion right there. Let's look at short terminal right here. Gap through on this candle. The closing price of that candle to right there is an imbalance. See right there? Resistance, support broken becomes resistance. Holy grail. Here we have another low. Candle gaps through. The imbalance is going to be right there. Closing price of this to that low. See, we trade up, wick through here, but watch the bodies. Imbalance being filled. Here again, gap through, imbalance is going to be from that dotted line to the closing price of this candle. That's the portion that they need to fill in. Watch this. Let me zoom up, not damage anybody's eyes. See that? Fill in, watch the bodies. Beautiful respect from the bodies, just beautiful. And then we move away. All right? So again, if you can find this on a time frame that allows for you to refine your entry, if you can find it in a time frame that allows you to refine your entry, it gets super, super sexy. Super, 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 super sexy. Let's go a daily chart. Let's start with any one of these. This low, candle close through is right here. Closing price of that. That's the imbalance right there. Wonderful randomness. Here's the low. Candle closes to the low is right here. This is where they need to rebalance. This was a big open gap. So we all know that if the open gap is there, it becomes a draw. So you have to still look at the market structure, look at what's there, and decide, is this an example where it's not likely to go higher? Is there anything up here above the dotted line that's pulling price? Or do we get a rebalance just to that dotted line and then we die? Right? Who knows? All right, so I think conceptually that is enough to explain the idea. Enough examples for you to see it as well. So with that, we'll wrap up this one and I'll leave you to your studies. I guess one more thing before I go is if we're looking at something like this. Let's say we're looking at something like this and we want to make it, well, this isn't finished yet. So let's look at one that's already finished. Previous day. If you want to make it sexy, London lows or session lows is, is an area to pay attention to. So if you tag that low right there, look at the candle that closes below, closing price. That's the imbalance that needs to get filled in between that line and that line. Look at it. Small stop up, a stop point above, but that's fine. Here we have it gapping through. So I'd be watching that low right there. If we can get above this right here, it's likely that the market's going to go back higher. If it can't get back above that line, then this guy is going to 10,700. That's what we have right there. So we can take that idea. Let's look at, I don't know what sessions you guys look at, any session, and look at lows of the session, the imbalances in the session, and watch them fill that in. Did that get completely filled in? Should they say, ah, nope. So that's still open in the market. So these are imbalances that you can pay attention to, watch them, and only look for confirmation entries. Don't have to overthink it. Again, here's London lows, bam, candle closes through it right there, bam. We can look for an entry pattern inside here while paying attention to the actual market structure that we have, because that tells you if we're likely to trade above here first or stop here. Okay, so now inside this fractal, zoom up, don't be too far. We have two relatively equal lows right here. That one and that one, right? This is the candle that closes through it. This is a portion of imbalance that could get filled in. This is also a low. See all these lows inside here that we closed below and didn't trade back up to, they get filled in right here. There's no way of telling how far the wicks could go. Well, let's not talk about that.
Stop the cap.
And then we could get involved right there. So, I mean, look at, I don't know how far this is. Let's see. That's a lot of wicks. That's a lot of wicks, but that's fine. If you use the idea that I'm always saying that, just use 2 time frames to trade, right? If you have 1 time frame that you use for your analysis, just drop to a lower time frame to refine. So this is June 13th. We drop to M5 on June 13th. Zoom out a little. This is that portion of price action we're looking at. If we look inside here, is there anything we could use to refine our entries? Let's kind of zoom out. So many things converging at that price that we could use to get involved. For instance, that's a signature that we learned recently. Ideally, we wanted to have here, and it did. It did have right here. So this would have been a trade. Maybe this wouldn't have been a trade for you based on time of day, but that's fine. This is the lunch hour. We all know about the lunch hour rally. Should. But there are lots of stuff inside here, man. Lots of stuff inside here. Lots of stuff. But stop hunt, highest closing up candle, something over here, give you an entry, and we're good. Every day of the week, let's pick a different pair. What's everybody's favorite pair? EU. Go back to previous day. So we have London lows, close to London lows. This right here would have been where you expect price to fill in. Going above that, again, is suggesting higher prices. So at this point in time, all right, let's say at this point in time, when this candle closes, right there, you're bullish, right? We're bullish. That's the range that the market's trading in. From here to here. So what we can see with our eyes, just for explanation purposes, let's say that's our range. Let's look a lot crowded. All right, now this looks even prettier. Lovely tagged at 50% of the range. Then we retrace. This low right here is asking for it. So we have a bullish market. We're in a discount end of the range. We have failure swings in discount. This is a sell. And if we miss this sell, it's a little bit sexy now. Let's take this off. It's a 5-minute chart. Let's tag this low. Let's tag closing price of that candle. Let's go to a 1-minute chart for fun. Beautiful. Look at that. Just look at that. Wonderfully random, of course. That would have been where we'd be looking to stock our entries. So many things are confluencing right here. We have a swing, 1, 2, 3 to the low. Ta-da. But yeah, that should be enough introduction to this idea. Wish you guys all the best and see you in the chat.